Hello and welcome. This is Gord Lemon for GoodMortgageRatesCanada.com, where my second opinion will save you thousands. Today I want to talk about how credit affects your borrowing power. In Canada, we have two main credit bureaus that keep track of all your credit scores. What they essentially do is they gather data from creditors and compile that and create a score, a Beacon score or a FICO score. And they each monitor your credit by monitoring your payment history, outstanding debt, duration of your credit history, types of credit you're using, and the new accounts you're creating. Your combined credit score is one of the most important factors in determining whether a lender will provide you with a mortgage or not. Lenders want to make sure that you are not a credit risk to them. If you pay your bills on time and don't take out too much debt, your scores are higher. However, if you take out debt and you're late with your payments consistently and you constantly pay the minimum amounts, well, your credit's going to be lower. The outside numbers of credit, so the two basic parameters are 300 to 900, although it's typical to find numbers between 500 and the low 800s. The higher the credit score, the more likely the borrower will actually meet their loan obligations. So you're a low risk. If you're at the other side of the spectrum and you've got a lower score, well, hey, that's okay, because we can help together improve your credit. There are key techniques in order to improve that, and your credit will repair and will be able to take advantage of better rates as your credit repairs. So I can help you with this, so please get in touch with me for that. So let's move forward. How is your credit score calculated? Well, you can see on the right there's a chart that puts sort of different weights to different categories here. So the most weight is on how much or how readily you repay your debts. So your payment history. Do you pay late? Do you pay on time? Do you pay the full amount? Or do you only pay the minimum amounts? The amount owed, which means how much of your balance is close to the limit you've been given. So if your balance is towards the top of your limit or it has even reached above it, well, your credit score is going to come down. So you want to make sure that your balance remains as low as possible. And the smaller divisions are the length of credit history, which indicates how long you've actually had your credit accounts. New credit, which shows are you a credit shopper or not. If you've gotten a lot of credit, that's okay to have a lot of credit. It's just how you're actually using it. And thirdly, the types of credit. So the types of loans or lines of credit you have and your credit cards. Are they department store cards or are they Visa, MasterCard, which is more desirable? And there are 3 levels of credit. So less than 640 means that you're dealing with higher rates with B lenders if you're trying to get a mortgage. And typically, this is a case-by-case basis, but typically there's no CMHC financing, which means you're putting a higher down payment down on the property. Secondly, you're in middle ground here, 640 to 680. You're looking at an A or a B lender. You can typically go up to 95% of purchase and 85% on a refinance. However, that is case-by-case basis. Your income qualification will have a lot to do with that as well. And of course, 680 plus, you're in good territory there. We're dealing with A lenders, which means we can get you the absolute best rates. You only need to put 5% down on a purchase, or you can go up to 85% loan to value on a refinance. So in closing, if your credit is poor, I can help you. We can work through that together. If your credit is okay, we can get you good rates. If your credit is excellent, of course, we can get you the absolute best rates that are out there. So please give me a call at 416-727-3222 and go to GoodMortgageRatesCanada.com. Thank you, and we'll see you next time.